From the morning reading, small caps and large caps sizzle while tech stocks fizzle. 6 of 10 sectors moved higher on Thursday. XLF, XLI, and XLB were the strongest sectors, while XLP was the weakest sector. Oil futures fell $1.05 to close at $44.29. Breadth weakened compared to the prior session as decliners led 1660 to 1432 on the New York Stock Exchange, and advancers led 1719 to 1083 on the NASDAQ. On the S&P 500 snapshot, the election rally moderates. The rally in the S&P 500 that began with Monday's 2.22% surge moderated with the previous session in a session that was marked with indecision. The index popped at the open and hit its 0.88% intraday high about 15 minutes later. It then reversed course and traded to its 0.56% negative low less than an hour after the high. The index then traded to a more restrained afternoon high before giving up much of its gain at its 0.20% closing tally. The 10-year note closed the session at 2.15, up another 8 basis points from the previous close, rather dramatic change from its 1.37% closing low in early July. In other morning reading, this is a split market. Because of the extreme move in bonds, the broad stock market has seen many stocks with a large move higher and many with a large move lower. As the Dow Industrials reached a new high on Thursday, the most securities in at least 50 years that trade on the New York Stock Exchange also reached a 52-week high or a 52-week low. When the Dow has been at a high in the past, along with a large number of 52-week highs and lows, it has led to weakness over the next 1 to 3 months. The move in the Dow has been impressive. It has gained for 4 days in a row and more than 5% to an all-time high that has led to some shorter-term weakness in the past as buyers take a rest. Initial election reactions tend to persist. There is a high positive correlation between how stocks' initial reaction to a presidential election and how they perform over the next month. Stocks and bonds are out of whack. The stock-bond ratio surged to 4.9 on Thursday, essentially meaning that the relationship between the two is nearly 5 standard deviations away from normal. No day since 1962 has come even close to this extreme. The next highest reading was 3.5 from January 23rd, 1985, and the next after that was a 3.4 from December 30th of 1991. Both led to higher stocks going forward, which is typical. Because of the historic moves in markets over the past 2 days, though, we're not placing as much weight on this measure as we have in past extremes. Signs of nerves in the bond market. Options volume on 10-year Treasury note futures was highest in history on Wednesday at more than 1 million contracts. The only other time it exceeded 1 million was on June 30th, 2013, and it got close on May 12th, 2015. This is a modest contrary nature of a put-call data in bonds, but isn't nearly as consistent as in stocks. Dow Industrials and transports are finally in sync. Transportation rally includes air freight, rails, and truckers. Copper uptrend accelerates as Freeport-McMoRan nears bullish breakout. Cyclical stocks outpace staples. Rotation out of growth into value stocks causes profit taken in technology. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:27 a.m. Mountain Time, and I'm recording this in preparation for the market day of November the 11th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut, all 4 of the U.S. broad-based indices were negative, albeit at some variable range. S&P futures are down 8 points, or about 1/3%. Russell futures are down just below scratch. NASDAQ futures are down about 0.8%, building on yesterday's weakness. Dow was down just below scratch. Crude oil, though, down big, down 1.32%. The euro down just below scratch, as is the long bond. Gold was down about 0.7%. In overseas action, looks like everybody was open. China was up about 0.8%. Hong Kong going the opposite direction, down about 1.3%. Japan up just above scratch. Germany was up about 0.4%. And United Kingdom, it was down about 1.25%. In terms of macroeconomic reports for today in the United States of note, you have FOMC member Fisher speaking. And then also note during trading hours, you have the University of Michigan Consumer Sentiment Report. In terms of current volatility conditions, yesterday was a very, very strange day. And I think it's the first time I have ever seen at one point yesterday where we had the NASDAQ at over 3 standard deviations down. At the same time, we had the Russell at over 2 standard deviations up. When it was all said and done and everybody closed, the S&P ended up at less than a 1 standard deviation move, though the Russell did hold on to a positive 1 standard deviation move at the same time that the NASDAQ closed at greater than 2 negative standard deviations. The Dow also put in a standard deviation size move. So really, really volatile activity, especially as you look at how the market has been responding in a rotation as individual companies, industry sectors, etc., are being kind of fleshed out as to expectations around, in effect, who's winners and losers in the election outcome on an individual basis. So I frankly would have thought much of that would have taken place on Wednesday, but that process was clearly continuing on yesterday's trading. You have short-term VIX has dropped down to a 14.12. SKU is also dropped, though, is still in the warning category at just above a 125. IV percentiles have also dropped dramatically in the last couple sessions. The S&P is at 28, the Russell's at 24, the NASDAQ's at 34, and the Dow is at 26. So a lot of volatility is scrubbed off, but there's still an awful lot of, within the individual sectors and industry groups, a lot of movement going on. So kind of keep that in mind. Let's go ahead and go to the charts. And we'll see a little bit of this. Let me get that lined up just a little better. There we go. We'll dial into the current action. You see, of course, we've had this big breakout on the S&P. And then yesterday we have, in essence, a spinning top, which is one of the candlesticks of some indecision. So far today, we have engulfed that to the downside, but these are relatively small actions so far. We'll have to see where this candle closes on today's action, but not terribly anything surprising at this point when you consider that from bottom to top in the futures market, were some probably 150 points in the last 2 sessions, that there would be a bit of digestion would certainly be expected. Also note that we're coming in very close to this area of resistance, and this would be expected to be a pretty significant area of resistance and would be expected to put a top on this market until it proves otherwise. So when you get this many touches, I mean, this is a pretty strong area of resistance. So while the short-term action has been very, very impressive, we're about to have a really, really big test. So kind of keep that in mind. Also on the Dow, though, you've passed that test and you have busted through that area of resistance, closed well above it. We've got a little bit of a small body action so far with today, but those, again, much like the S&P, this is a huge move in the last couple sessions. That we'd have some digest is not unexpected, and indeed I wouldn't be surprised to see if the Dow retraces back to the prior resistance, now should be support, and that we see a test of that. So see if indeed we do come back and touch this area, maybe not to the tick, but to the area, and then resume. If this is going to be anything of a real breakout, this area needs to hold and not just let this thing false break out and break back down into the range. So that'll be one of the first tests that we'll see as to whether this move higher across the indices is for real. When the breakouts occur, they've got to hold. Now, the Russell also up against this area of resistance, very close, and it's trading. It's literally within 1 day of being able to get to this former all-time high, so we'll also be watching that. So you got the Dow out in front and looking for a potential retest, and you have the S&P and the Russell also playing in the area of resistance. So very, very interesting times there. Now the NASDAQ, that's the one that we were talking about a few moments ago, and a totally different kind of behavior. And if you look at all the big caps, you know, Amazon, Apple, Facebook, it seemed like all the kind of Google, the FANG stocks and so forth, all the big tech stocks were struggling yesterday seemingly, and that weakness has continued into this morning. So is this part of the sector rotation? Is there something else going on? It's certainly not your kind of classic risk on, risk off. Some people have suggested that with some of the trade deal talk that's going on post-election, that might not be as good for some of these tech stocks as it is for some of these others. You take for the Russell, for example, you know, where the cost of borrowing and so forth is, you know, very much present on the minds of these guys, as they're small, growth-oriented companies, generally aren't paying dividends, but are often in debt as they try to grow their companies. You know, the outcome would seem to be favoring this group of companies versus where you've got with the NASDAQ, often companies like Apple with literally a couple $100 billion plus in cash on hand. Not so much about borrowing as it is about free trade and that implication. So again, we'll start to see more and more of this going forward as these companies readjust to a new dynamic. Now, right now, they're acting on what they think they know as what a Trump administration will do. But of course, many of those policies that were outlined during the pre-election period, you know, have to meet reality and be run through Congress and other parts of the process. So this will continue to evolve as more information becomes known. But that's the tenet of technical analysis. As information becomes known, it's priced in. And so this situation will continue to become better understood as these policies actually become better known and better understood as to their fine details. Let's take a look at some of the other markets. Crude oil has been showing pretty significant weakness and is in danger of breaking its near-term support area. If it does, it certainly will come down here to the 618 fib retracement. That would seem to be a pretty obvious area of support, and that also lines up with these previous swing area right here from both of these swings. So that would be a pretty good support cluster of both known horizontal and hidden fib retracement support. So that would be a pretty obvious target right around 43 and change. If we get through that area, then we probably end up with a full 100% retracement down to the $39 and change. If support does hold, then we just end up with this kind of complex consolidation pattern, albeit some wide pattern, but we'll continue to watch that pattern. Gold has also been something of a retracement pattern and is down also near its intermediate term and short term support areas. So we'll watch to see if that holds. Bonds, of course, have been doing a great unwind and are clearly now in an intermediate term bear. In fact, I'd call this a strong bear down on the long bond. Let's take a look at the dollar. Dollar, of course, has been playing up near resistance. Now, if it breaks through this swing area, it certainly has some resistance areas not too far above, around the $100 and the $100.60 area, which was the all-time high for the dollar about this time last year. And then, of course, let's see here. Let's take a look at volatility. Volatility, of course, had something of a crush in recent days. And it's come up a little bit yesterday. Remember, we had those big tech stocks that were exhibiting some volatility yesterday. And like Apple's both, a tech as well as being in the S&P 100. So you get kind of this union of impacts across multiple different indices, and as a member of the S&P would certainly be part of the factor of people in put buying and so forth, and that then shows up as part of your volatility. Okay, that's probably enough on the charts right now. Let's go ahead and go to the daily report, and there are some significant changes on the daily report today. First of all, we have seen a change on the intermediate term phase opinion to market phase 2. This is a positive change. This is a trend reversal phase. And clearly with the recent action, we've seen some significant bullish action, and this has gone from what was a market phase 5, a bearish kind of phase, into a bullish kind of phase. We also, on the 3 market timing signals, all 3 mechanical in nature, coming from 3 separate systems. The first one from IBD and confirmed uptrend. The second one from GMI index, a much improved 5 out of 6, but also now a buy signal. So as of yesterday, this one has also flipped. In terms of the stock charts decision point scoreboard, we have improvement. We don't have a clean stack yet. It's still a pretty big mess between the multiple time frames and the multiple index, but still improvement. You had NASDAQ actually deteriorated to a neutral on the trend model signal, but you had the Dow on the intermediate term issue a bullish signal. Now, overall, short term, mostly bullish across the different indices. On the intermediate term, mostly neutral to bearish, with a couple bullish signals mixed in there. So very, very mixed on the intermediate term. And then, of course, totally mixed on the long term. So this is the weakest part of the mechanical signals. Overall consensus here is certainly much improved from where it was a couple sessions ago, or in last week for sure. At the same time, it is a situation where it is not a clean, strong bull market by any means as of yet. So just kind of be somewhat cautious as you start to expose yourself to more bullish delta. At the same time, aware that we don't have this clean signal. We're up against resistance on the Russell and the S&P. As we start to establish potential breakouts on more index and then confirm those breakouts, you should feel gathering confidence and being able to add exposure. Position sizing opinions on both models are back to 100%. Intermediate term market postures have also firmed up. The S&P now has issued a strong bull signal. The Dow also strong bull. The Russell strong bull. NASDAQ a little bit weaker at weak bull and is below the 50, but not by much. In terms of the hedge warning status, we've dropped this down again to a level 1+. This is a caution light area. We will gain confidence in this move as we see more confirming indicators, but we are recognizing that many of the warning levels that we saw in sessions just a few sessions ago that gave us the hedge warning level 3 have ebbed, and we want to recognize that in a timely manner, though we are generally fairly cautious at how fast we take these off. In terms of the strategy opinions, the VIX is within the acceptable window to initiate new positions for novice traders. Caution is suggested while noting that the hedge risk level is decreasing. On cover calls on put selling, conditions are back to acceptable to initiate new positions for novice traders. And traders should consider, though, relatively defensive structures, such as 2-to-1 ratios of in-the-money, out-of-the-money strikes, 2-to-1 ratios of low beta. Be selective on your low beta. Remember, this inflation and interest rate sensitive areas are something of a rotation right now. But low beta versus high beta, 2-to-1. Also, put selling, start looking for opportunities there as well to increase your delta exposure as this market continues to kind of confirm. When we go to the specific warning areas, note there is a lot more black here, and indeed the red is starting to be the exception. Still relatively high distribution day count, and we have just above the warning status on the skew. So about a 9% probability of a 2 standard deviation move in the next 30 days. Trend based, everything back to normal settings. Key intermarket risk aversion indicators all risk on. Sentiment has gone back to neutral. So a lot of change that's occurred in those areas in the last few days. One thing I should note here is that while some of these certainly have sensitivity to short-term price action, most of this is really dialed in to the intermediate term time frame, trading frame. So while responsive to significant moves, this really is focused on the intermediate term, and you know, the last 3 weeks obviously driven by an awareness of election and anticipation of what people in the conventional wisdom thought was going to happen, and then the great unwind of that failure of the conventional wisdom. So that certainly has impacted our risk level and our warning status and so forth. But back up a step and also keep in mind the bigger picture as we consider, and investing and trading horizons, and those can be quite different. Your trading horizons for at least myself is generally the intermediate term time frame, but an investment horizon, while we use the intermediate term to help time our entries and exits on investments, that horizon can be somewhat different. In terms of sector specific, again, more of that rotation. So financials, healthcare, materials, energy, doing well as they did the prior session, and some very, very robust numbers here. Financials up almost 4% yesterday, while seeing some movement away from consumer staples and utilities, in particular, also interest rate sensitive real estate. So big sector rotation going on, and that did definitely continue yesterday. We're starting to see this also reflect better in our intermediate term market postures by sector. And indeed, if you look across, we're starting to see a little more consistency across the time frame. And if you saw the individual indicators, you'd see there's some real sharp inflections in slope and separation going on now. So instead of just being wound tightly around the horizontal lines, we're starting to see some real movement in some of these sectors. So clear rotation is going on. And you see the same thing as we now look at the 1 day, the 5 day, the 1 month into the 3 month. Financials back to the top where they've been, but now with new energy. And then also healthcare, a clear rotation from, really poor performance before the election into a very strong performance since the election. So a lot of rotation going into healthcare, even big healthcare like Pfizer, up several percentage points in recent trading action. Whereas on the flip side, you see consumer staples and utilities are really suffering the rotation out. So that should be enough for today. Let's go ahead and wrap this thing up. We've been long all week with so much information at play. Disclaimers, as always, hit the pause button if you need more time with the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll be back here for our next market preview from Falcon Global with the Monday market preview. In the meantime, manage that risk, look for that consistency in your performance, and seek to go out there and learn something about your craft each and every day.